And welcome back. My name is David Levinstein, executive producer at 1039 LI News Radio, and I'm here with our portfolio repairman, Mr. Jan Haagen. He is the president and founder of the Haagen Financial Group, and his phone number is 631-425-1966. 631-425-1966. You can visit him at Haagen, that's TENHAAGEN, Haagen.com. And we're talking about your money that you should be investing in yourself, right?
Absolutely.
Now, how they invest that money should really be something, when you take it into consideration, their risk tolerance, their time horizon, and working with a certified financial planner. Tell us why, rather than choosing the popular no-load fund of the day.
Well, who's going to give you any guidance with that popular no-load or load, whatever it may be? You've got to find somebody that has your best interest in life. In fact, April of this next year, 17, the Department of Labor, DOL, is coming out with a ruling of fiduciary responsibility for stockbrokers, insurance people, etc. As a certified financial planner since '82, every year I sign a form saying I am a fiduciary, meaning that you're coming to me for guidance in investing. I am looking out for...
What responsibility does that put on the fiduciary of someone's accounts?
What it means is that I've got to look out for what is the best investment for my client, not what's the best investment to put money in my pocket.
You're not taking a responsibility for the returns of the account, though.
Not at all.
No, the market can be...
the market's the market.
And it's affected by not just economic matters, but it could be international matters as well. It could be anything that's newsworthy can affect the market.
Absolutely.
People are you got a very sensitive trigger finger when it comes to the stock market.
Well, the media is looking for getting your attention instantly.
Right.
So it's sound bites for the day.
Right.
Like one time I was on a television program, and happened to be that day the market was down 600 points.
Right.
Which, if you look at in the scheme of things, 600 points today is minuscule based on 20,000.
Right.
But a good number of years ago, when the Dow was at 2,500 and we had a 40% drop, that woke us all up.
Hey, when there was the Brexit vote, in the middle of this year, and the stock market dropped 300 or 400 points one day, 200 points another day, and we've all but forgotten about that.
Well, it was 600 points was the biggest during that thing. I happened to be called. I was on another show, and they said, what's going on? What's going on? I said, one, it's going to take England at least 2 years to unwrap themselves from the Brexit. And so it's knee-jerk reaction. It's the media hype. Take a deep breath.
You think the media hype has to do with the burst in the market right now? No, I don't look at it as a burst.
No.
I mean, I'm looking at where the market was 6 months ago, and it seems to be just a gradual upswing in investments. People have a lot of confidence in the market because that's why money goes in, right?
Well, you look at the market, you look at Washington. Washington has gotten bogged down and just can't get out of their own way. There is a breath of fresh air that's coming into Washington. Some people say it's a tornado. Some say it's just a nice breath of fresh air.
Here's how I look at it this way. I look at it that people are finding more comfort in the private sector than they are in government, which is why they're investing in companies, right? Stocks versus government bonds. They're not buying bonds. If they were buying bonds, the bond market would react positively to that, but they're not buying bonds.
Well, the reason for bonds is that interest rates are at the lowest they've been in I can remember.
Right.
And the Fed is starting to raise rates, but they've lost pretty much all their credibility because, we're going to raise them, No, we're not this time. Yes, we are. No, we're not. So the bond market is not correlated to the equity stock market. What's happening is people are seeing, hey, maybe Washington is going to change from the nothing to there's an opportunity, and you get business people in there to run it like a business. And businesses outside are saying, hey, we're going to have a little bit more freedom to do what we need to do to get our company going.
Right, but between the equity market and between the dividends that a lot of these stocks pay, right, versus which are in some cases double what the government is paying on bonds right now.
Oh, it's much more than
maybe
double.
more than that. Well, maybe more so. And if you want to even get close or nearly close, you're going to have to go out so far in a bond. What that means is you're going to have a 30-year maturity in a bond. And I don't think anyone's really willing to lock up their money for 30 years.
I certainly wouldn't suggest anybody do that. No.
So when the government looks at their bank accounts and they say, hey, we have no money, where is all the money? The money's right now in the stock market. That's where the money is. And the government's going to, at one point, they're going to need money. Well, and they got to raise rates to bring some money home.
Some of the bigger companies out there that are paying dividends are paying 2.5%, 3.5%, even 4%.
Right.
Now, if you go into a bank to a savings account at 0.01%,
right,
using the law of 72, your money's going to double every 1,000 years. How many 1,000 years time periods do you have until you retire?
Not too many.
I didn't think so.
And not too many.
Right.
But stocks have proven to be, over time, a much, I think, a stronger investment than any type of government bond that has been issued.
The market has been the success of many, many, many people. Right. Big investors and small.
I'm speaking with Mr. Jan Tenhagen from the Tenhagen Financial Group. His website is TENHAAGEN, and he has 3 offices. One's located in Northport, the other in Huntington, and the other in Manhattan. And he's a portfolio repairman. He's on every Saturday afternoon right here on 103.9 LI News Radio. So to go back to what we're talking about, so between 2006, 2008, 2010, 11, your year-end letter to your clients, your newsletter, right, has read the same for all those years, regardless of who's sitting in the White House, regardless of where interest rates are, regardless of where the market is, right?
Right. And what we're doing now is what all the media programs do. We're talking about the markets. I want to talk to the individuals out there who have not started with their 401k, or if they did, they haven't looked at it in a long time.
Right.
They haven't increased the amount going in there. So how do they determine it's a good investment, bad investment? And just a statistic here, the compound annual return on the Standard & Poor's 500 for the 30-year period from July 79 to July of 09 was 10.25%, or 3/4%.
Right.
In the 20-year period from 89 to 09, it was 7.75%. So if you consider, let's just say, an 8% return on your money.
Right.
If you start 10 years before the other person, in that situation, it's about $95,000 more in your pocket, your investment, than not. So wouldn't it behoove you to start today rather than I'll get around to it sometime?
Right. Is that scary for some people who have never been in the market to step in?
Well, yeah, because most 401ks, some wholesaler guy comes in and talks to you like, oh, yeah, this is great, da-da-da. What you need is somebody that is interested in you and your personal needs and your personal situation to go forward.
Right. There are probably more mutual funds out there than there are stocks in the S&P 500, I would imagine.
Categorically, yes.
So how do people discern what the best mutual fund is? I mean, you're going to look at the last 2, 6, 8, 9, 12-year return of a mutual fund. You can't.
You can, but
that would not be the right way to go.
Well, Morningstar, which rates mutual funds, has a star system: 1, 2, 3, 4, 5. 5 being the best, 1 being the worst.
Right.
You take 5 years ago the 5 stars, and you look today at where they are. Very few of them are still a 5-star. So you've got to pick and choose quality over time and then keep reviewing it to make sure that's where it stayed.
Yeah. Morningstar, by the way, is an independent, right?
Totally.
People don't pay to be reviewed by the Morningstar like they do in the rating systems, like Moody's and S&P. Right? They don't pay for that rating system. Morningstar is an independent. You can go to Morningstar.com and you can find and put your mutual fund symbol in there, and you can get an independent Morningstar rating of your particular mutual fund. Now, the Morningstar rating system, 1 through 5 stars, also talks about the relative risk of that fund to the investor.
That's another section of it. Yes.
Right. So the risk, when you look at the risk of your mutual fund, and you take a relative look at the time that you're allowing yourself in the market before you need the market, those are things that need to be married together and taken into consideration when investing, right?
Well, very much so, because you can have a 5-star that's a gold-plated company.
Right.
Or you can have one which is a small cap, or it can be anywhere at any time to be
Right.
5-star.
Right.
You got to see what kind of comfort level is in there for you.
Right.
The bottom line, and this is interesting, is time is money in the case of your finances and investments. This is part of my newsletter.
Yeah.
And it says the University of Chicago research found the key to financial success is getting started.
Right.
And how many people out there have not gotten started for whatever reason?
Right.
Sit down, talk to your spouse, get a good financial advisor, and interview them to see, are they really looking out for your best interest.
And the person you need to call is Mr. Jan Haagen. He is a certified financial planner. He's been in the business for more than 2 years, I would imagine, right?
More than 30.
More than 30. He's seen markets. He's worked with generations in his own portfolio, in his own book of clients. And I urge you to give him a call if you're considering first stepping into the market, or if you're working with a financial planner who you feel as though is not looking at your investments in your best interest.
And every person that comes in, it's a second opinion,
Right.
Totally no obligation.
631-425-1966, the year I was born. 631-425-1966. It's the Haagen Financial Group. Jan Haagen, he is our portfolio repairman, and he has offices in Northport, in Huntington, and Manhattan.